Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for March 1st, 2021. Please see our disclaimer for important information. And here we have our weekly COVID tracker showing the 7-day moving average of both new positive cases as well as new daily deaths. What we see here is a continuation of a trend that we've been watching essentially for the last month and a half here, dating back to the beginning of the year. We see a continued downslope in the new case volumes, even though that number seems to have kind of like bottomed out here on an interim basis, as well as daily deaths too. We've had a nice plateau and then a dropping off. We know that data, the death data, runs at kind of a 14-day lag to the new cases, and so both of those are on a net basis showing positive trends. Now we'll have to see in the coming weeks where these data lines go from here. We do feel like there's been some disruption in maybe some reporting sites and whatnot. We've had, obviously, with the bad weather, there was a lot of disruption in terms of the testing that was going on, as well as what's been reported to the local and state agencies. So right now there may be a little bit of noise in the data, but the overall trend is very, very positive. This is our chart showing the daily vaccine doses that are being administered here in the U.S. And as we expected when we were talking about this last week, the storms in the Southwest really did have an impact on the ability to get those doses administered. Many of those sites were snowed under, closed. Many places were not administering vaccines during that week of that storm. And so here we are with a little bit of a decline. I wouldn't worry too much about it because it really did have an impact. And I'd say there are probably perhaps 1 million doses that were not even administered in Texas alone during the week of the storms. But would expect that number again turns upward sloping here next week and continues on in that upward sloping manner hereafter. We've shown you this a few times. This is the vaccine doses administered by type, and so obviously the two lead horses here are Pfizer, BioNTech, and Moderna. And just this week we're getting word that Johnson & Johnson's therapy, its own vaccine, it's a one-shot regimen, received its emergency use authorization. So we'll have a third major vaccine on the market. And again, you know, there's been talk on the Pfizer side and perhaps even on the Moderna side that, you know, even though a two-shot regimen might be 90 to 95% efficacious in forestalling the infection, even a one-shot dose gives you something that's on par with what the J&J vaccine, the J&J one-shot vaccine is able to deliver, and that's about a 55 to 60% efficacious number. So there is some thought about expanding the vaccines by at least giving everyone one shot, but then perhaps focusing on 2 shots for the most vulnerable in that 1B category. We'll have to wait and see. I really do think with the advent of J&J on the market now, that will be, you know, 2 months down the road, and we'll have probably more vaccines than we have arms to put them in. The interesting chart that comes to us by way of the CDC and assembled by our friends at First Trust Advisors. So this is a kind of a breakdown by age of who's received the vaccine, what part of that age cohort has received the vaccine. And I guess what's really poignant here is that you know, that these numbers provided by the CDC tend to suggest that 12.6% of the population overall has received at least one dose of the vaccine. Now, if you're in the 75 age or above cohort, then that number is about 54%. And then even in the 65 to 74 age group, at least a third of those have received at least one shot. And so that is at least, you know, on one level, the elderly is who we need to get vaccinated because they are the most vulnerable, as well as the rest of the 1Bs that have underlying conditions too. But an interesting chart that shows that age progression, and obviously as those numbers on the upper end of that, or the right-hand side of that scale, go higher, then you'll start to see those lower age cohorts begin to backfill. This is something that I thought was really interesting, and it really shows that the vaccine is working. So, one of the top priorities in the 1A and 1B category was to inoculate those that were in long-term care facilities. And so these were people, a lot of whom received the vaccine very early on when the vaccine was the first emergency use authorization was granted. And as you can see here, certainly after the beginning of the year, as more of those folks were vaccinated, that the rate of incidence of the COVID-19 virus has gone way down, even well before the mini surge last summer, as well as the surge last fall. So very positive sign, I think, representative of the fact that the vaccines are in fact working. Here's the path to immunity chart that we've shown you several times. Again, this is data that's provided to us by CDC and assembled by our friends up in Chicago, First Trust. But we continue to see that upward sloping glide path. The green bars, or the components of those columns, represent the U.S. individuals who've received at least one vaccine, or perhaps two. And we've seen here already in the slide that number is about 12 to 13% of the overall population. So that's a positive sign. And then again, if you add in those who have had the virus and ostensibly have the antibodies for it, and those who probably have had the virus and never knew it because they were asymptomatic, we're getting higher and higher each week towards that ultimate goal of herd immunity. Here's our high frequency data for this week, and as you can see here, as we monitor this every week, that there's always some puts and takes. But I'm really not going to go down the list this week, but just focus on a couple of things. Rail car traffic is down rather significantly for the week and for the month. A lot of that has to do with mobility related to the storm, so I'm not worried about that number at all. Because we do know that durable goods purchasing and consumer spending remains very agreeable. Hotel and hospitality has been high. A lot of that has actually been positively influenced because people were displaced from their homes and had to go stay in a hotel. But even on the restaurant side, where even in some of those areas that were really affected by the weather, that if you even including that, the revenue data is positive both in the week and the month. So on balance, continued good data as well as the jobless information, which has recently trended a little bit more positive. So we'll start talking about the equity markets and inflation a little bit. This chart represents cumulative net inflows into equities and bonds. Now, these are flows into ETFs, or exchange traded funds, dating all the way back to 2008. And so if you assume that 2008 is kind of our 0 point, you can see that from a cumulative standpoint, we've had a nice stretch where equities and bonds were both receiving new cash inflows. But the equity number, even though we've been talking about this recently, that there's been a lot of inflow back into equities, but on a relative basis, it really hasn't been that way. I mean, bond ETF funds have taken in much more in terms of net liquidity than equity ETFs have. And this is not a 2020 problem. This is something that's been going on for quite a number of years now, actually. And as you can see here, that number seems to even be diverging, despite the fact that we're at record levels on the equity indices. There appears to be a pretty fair amount I'd say momentum is a strong word, but a pretty fair amount of wind behind the sails for the equity market looking ahead. This is a chart of the U.S. 10-year Treasury break-even yield. And so what does this represent? So this is basically the difference between the 10-year Treasury, which we know is been pushing close to 1.5% here lately, and then the actual rate of, or essentially the TIPS yield, so the inflation protected security that has the same maturity, and if you basically subtract that out, you get to the net break-even 10-year yield, and that's about 2.2 right now. And so what this represents is the market's interpretation of where inflation is right now. So that's the key takeaway from this chart, is the market is now pricing in about 2.2% inflation over the next 10 years on here. And you can see from this chart just visually that, we were essentially at that level, for a while. In 2018 we were there. It slid in 2019, but we were still about 1.75 on break-even yield when we hit the pandemic. And so what we've done now is we not only kind of retraced that loss throughout the latter half of last year, but we've kind of broken through that technical support or ceiling, if you will, and we've established kind of a new trend line, if you will. So this is the market telling us that that we're beginning to price in a little bit more inflation looking ahead. I'm pretty sure I've shown this chart. It's been several months, but it's a chart that is produced by Fidelity from data that's accumulated by Strategas. And it just shows you the two major cycles that we've had in interest rates dating all the way back to the end of World War II. We had a very strong secular rise in yields over essentially 3 to 4 decades, culminating in 1982. And then at that point, we began that secular bull market in fixed income where rates dropped precipitously and prices rose accordingly. And so, it's been a good place to be in fixed income for the last 40 years because not only could you essentially ride the yield curve, but also, as we've seen a secular decrease in yields, that the value of longer dated securities has certainly gone up, and it's paid over a long period of time to own long dated securities because you get that yield. Now, where we are now, we've had a couple of, I guess, call it false bottoms, if you will, where we thought that we were at about as low as we were going to go on yield, and then lo and behold, we have a pandemic and they go even lower. But you can see here that these trend lines are extremely long. So it takes a lot to move this ship in a different direction. Now, the big question right now is whether this inflation push, the chart that I just showed you, where inflation expectations are rising in the fixed income market, if this is going to translate into a meaningful and sustainable rise in 10-year yields. And that is something that we just don't know yet because we don't know how much inflation we're going to get that will provide the impetus for that. Here's the 10-year Treasury, looking at it kind of a bit more of a microcosm. So this shows you essentially where we've been trading, over the last 10 years. And I would argue to some degree, and this is articulated in the Fidelity piece, that we're getting back up to normalization on where that 10-year is, even though we've got an anchor on short-term rates, because that's the Federal Reserve's domain, and they've told us that they're going to let inflation perhaps run a little bit hot before they decide to raise short-term interest rates. But we know the longer-term rates are influenced more by inflation expectations. And with those rising, what we're seeing here is not anything that should be unexpected to a large degree. We're just seeing a lot of normalization in the 10-year yield. I thought this chart was really interesting. It was on a Twitter feed, and it plots the S&P 500 it's dating back to the end of 2019 against global liquidity. And I had another chart for liquidity that I was going to show, but then this one just really kind of underscored what the relationship is. So with increased liquidity, we've had obviously a very strong equity market, and this is global liquidity. So this is liquidity in central banks across the globe, and checkable deposits in foreign bank accounts, and also liquidity in investment and brokerage accounts overseas and things like that, including the U.S. And so there's a really tight relationship here. And what I'll tell you is that the liquidity equation is not going away. So there's still going to be plenty of liquidity in the system. And by this relationship alone, it should have a fairly meaningful influence on equities going forward. This is an interesting chart that was pulled out of Strategis and also reported by Fidelity. And it shows the price to earnings ratio by levels of inflation. And so what does that mean? And this goes back to 1950. And so the net of this, and I'll explain it in kind of a little bit broader detail, the net of this is that when you have low inflation, that your equity market tends to run at a higher multiple of earnings. Your price to earnings ratio is higher the lower the inflation you have. And so in that first bar on the left, when you've actually had a negative inflation number, the market on average dating back to 1950, when you've had that case, the market's traded about 17 times earnings, or a little bit higher than the long-term average. Now, if you have slight inflation, like from 0 to 2% inflation, which is kind of where we are now, you've got an 18 times multiple. So this chart would help to explain why the market's running a little bit hot in terms of multiple, and it provides a justification for it. Now, if you start adding inflation to the mix on that third line where it's 2 to 4%, you still run hotter than you were running if you were in a deflationary environment, but not quite as high as if you had relatively benign inflation. And then as you trend on over to the right, when you have higher inflation, that's when you begin to see that really negative relationship that high inflation has with equities. And so this is what we've been talking about over the last several weeks as we've seen this inflation expectation beginning to build. Is what we don't want to see is a sudden expectation that we're going to have a burst of inflation that's going to be on the order of 4, 5, 6% which I don't think is in the offing, but I'm just saying that the risk of that by this chart will tell you that it's going to create a more difficult environment for equities. This is a chart that's breaking down the CPI, or the Consumer Price Index, by category. And what's really important here, and the reason why I wanted to show it to you, is that we've talked a lot about inflation impetus. We've talked a lot about inflation expectations and wanting to guard against unexpected bursts of inflation. And this chart kind of breaks down what the impetus is here for the CPI. And as you can see on the left-hand side, a lot of it has to do with housing. At one point, housing accounted for about 30% to a third of inflation, and as prices have really rocketed in the strength in the housing sector, we've seen that number increase. So housing has an outsized influence on overall inflation. And if you think about the scarcity of housing in many markets across the country, I think it's fair to assume that you're not going to see that influence abate to a large degree looking into the latter half of this year, certainly, and then even into 2022. So other components that have an influence are food and beverage, of course, transportation, which kind of go to that energy and food component that sometimes you'll see get taken out when you calculate core inflation. But then downstream from that, you have medical care and education, so on and so forth. But housing clearly is the main driver for overall CPI, consumer price inflation, right now. And to wit, here's a chart of existing house price by median family income. So this is not showing you necessarily housing price inflation, but it's showing you the impact of house price appreciation on overall affordability. And so what this line represents is you actually take the house price proxy, or the index, if you will, and then you divide that by the median family income. And so what this is telling you is that housing prices are outpacing family income right here. And we've obviously seen this before too, most notably here in the housing bubble that preceded the global financial crisis, which really started in 2006 and kind of ensued into 2007, and then basically the bubble burst in 2008. And so we're not quite at those levels yet, but it is noteworthy to show that we're clearly higher than we've been for quite some time, and certainly over a much longer term basis. Here's the money supply. Again, I've got a couple of these charts on liquidity, which I think are all noteworthy right now. So, this is kind of another chart that gives me some comfort when I talk about the sustainability of the equity market. Liquidity in its purest form, is searching for a higher and better place for placement. And in this case, it'd be investment in private enterprise. It'd be investment in the stock market. It'd be an investment in foreign direct investment in other attractive areas of the world. But this is liquidity that ostensibly is going to be looking for a home. And now a lot of this represents, both fiscal and monetary policy effects. Now, in the global financial crisis, we had a bit of a spike in money supply, not anywhere close to what we've seen here. These government stimulus checks have just had a huge impact on money supply. And but back in the global financial crisis, a lot of it was done just to shore up the banks' balance sheets, which it did, but the banks didn't lend it out. They retained it and they held it on deposit with the Fed. So it didn't have the same kind of economic impact that I think that this liquidity that we're sitting on here today will ultimately have on our economy in the years ahead. Here is personal savings as a percent of disposable personal income. And so I think you could read into this well enough that the stimulus checks that people received and the unemployment extensions and benefits that were laid out in the CARES Act were all inputs into what you see on this chart. And that's clearly the spike that you saw when there was the immediate and rapid response to the shutdowns. And then what you also see here is the effect of the follow-on kind of round two. And of course, if we have more stimulus, which I do believe we're going to have at some point, that's just going to continue to drive the savings rate as a percent of disposable personal income higher. Now, this is good for a lot of different reasons, because the consumer accounts for 65, 70% of the economy. And if you have personal savings that are robust, it gives the consumer a lot of seed corn to put back into the economy in terms of consumption, which I do think that that this provides a lot of comfort to this notion of the investment markets continuing to excel here looking ahead. So this is just another representation of liquidity. I thought I'd kind of throw the kitchen sink at you this week in terms of the data. But on the left-hand side are essentially checkable bank deposits. This is data that comes to us from the Federal Deposit Insurance Corporation that tracks financial institutions. You can see that that's a pretty linear increase until you get to the pandemic, and then it really just almost goes straight up. And so we're sitting on a lot of bank deposits. This goes hand in glove with the chart that I showed you previously, which is the personal savings as a percent of disposable personal income. So this is just liquidity in the bank. This is money that's been doled out by the government, that's been saved, that's ready to be deployed. And if you look on the right-hand side, and you've heard me talk about this number before, but this kind of shows you the glide path to get to where we are. At this point, we're sitting on essentially about $1.6 trillion in excess savings, which is really profound. And you can see how that continues to increase without any abatement whatsoever. Now here's a chart that I'm going to love to describe to you. So this is a scatter plot of bull markets from 1928 to the present. This is the S&P 500. So what it shows you on the lower axis, the x-axis, is the duration of the bull market. And on the y-axis, it shows you the percent of gain during that bull market. And so these are all plots of individual bull markets, and it gives you their timestamp. And so, a couple of reference points. So the average over all of this time, dating back to 1928, the average duration of the bull market's been 62 months, or about 5 years, and the average gain during that bull market's been 183%. Now, before the pandemic hit, we were in a historically long bull market, and you can see that in the upper right, 2009 to 2020. We had a very long duration, and we also had an over 400% aggregate advance in that bull market during that time. So it's an anomaly. There are a lot of reasons behind that we've long discussed, but those are kind of your two reference points. So now where we sit right now, we all know that the pandemic hit, everything went down. A lot of anxiety and panic and kind of lack of euphoria, to be sure. But then we have this rocket ship of a recovery. And, in terms of duration, we're really not even scratching the surface. I mean, you've got to go literally another year before you hit the next longest bull market. And so from that standpoint alone, it would seem to reason that we've got more duration left in this bull market. And then from a return standpoint, you can see that there's a cluster of outcomes here that kind of range from, looking at the x-axis from about, 25 months all the way out to about, 80 to 90. And that's kind of where the cluster is. And the average return of those, if you had a line of best fit, would be, about 125, 150 maybe. So, and if you get to that average of 183, taking all of that into consideration, it just seems to reason by this chart that we've got more run left in our equity markets. And as we've talked about, we've got a lot of liquidity on the sidelines. We have a conducive and gradual economic growth that we're looking at here. And as long as we don't have the inflation surprise, which would be negative, then by this chart, it would seem to reason that we've got more run left in our equity market. Here's our EPS progression data that was provided by Strategis. And what this shows you here is that we basically have recovered our earnings estimates that we had entering last year before the pandemic. We were sitting at about $180, $175, $180 a share for the S&P 500 index. These are 12-month forward EPS estimates. And then obviously when the pandemic hit, we experienced a lot of financial retrenchment, et cetera, that those estimates dropped precipitously. But the good news is that we've now finally regained those prior levels, which I think is positive for the market. And to the extent that we can continue to expand earnings in this recovery, that will definitely be positive for future equity growth. All right, and here's our plot of the S&P 500 dividend yield less the 10-year Treasury yield. And what this tells you is that we finally have reached a point where the 10-year Treasury yield exceeds the dividend yield for the S&P 500. And as you can tell, that has not been the case. We were there as interest rates were rising up into the pandemic, but then that obviously reversed, and so it's taken us a while to kind of get back to where we were at the beginning of last year. but we have done it. And this is the normal environment, if you will, where you have, when you're not necessarily in a kind of a flat yield curve standpoint, you're in a kind of a steepening environment or a steeper environment where you have a conducive equity market. You frankly should have a 10-year Treasury that exceeds the S&P 500 dividend yield. I thought I'd throw this in for good measure because ironically it looks a little bit like the gold chart here, but on a totally different scale. For all that's been said about Bitcoin and who's been buying it, and is it going to become a currency of choice and a reserve currency at some point? I think those types of decisions are a long ways away. This is far too volatile to be even remotely considered, not only as a currency, but especially as a reserve currency. But as we see here, Bitcoin has had quite a violent reversal and continues to be volatile. I think I would continue to treat Bitcoin as a very interesting but speculative investment. We haven't talked about unemployment and the labor market in a lot of depth here over the last few weeks, so I thought I'd go ahead and update you with the data for the claims for new unemployment benefits, as well as the continuing claims, which is a figure that we always care about. And in both cases, I think we see some health in the market. Now, we've had puts and takes in terms of the new claims for unemployment insurance. We've had a little bit of a multi-week spike leading up into the beginning of February, and then we've seen that number tail off quite a bit. And especially in that last reading. So claims, and not only the unusual or the unique pandemic-related claims have dropped off somewhat as well. But in particular, on the continuing claims side, we see on the regular benefits, we see a continued slow decline, which is extremely healthy. Now, we've seen an uptick in some of the extended benefits as well as the pandemic emergency unemployment compensation, but maybe there's been some borrowing of people that are applying for that pandemic-related coverage that are kind of rolling off the regular benefit side. But the bottom line is that this is all kind of trending in the right direction, at least for the moment. And we'd like to kind of remind you in the durable goods space that this is one chart that on the left-hand side kind of tells you that prices are moving higher. Now, we've shown various iterations of this over the last several weeks, and it's a trend that's not going away. So I think this is, again, fueling some of this inflation speculation that you have producer prices that are moving higher. So you've got in the green line, raw materials are going up. Prices received for finished product are going up, but not at the same pace. So we expect to see perhaps a little bit of catch up. What this chart will tell you is that there are periods of time where input prices are going up higher than selling prices are, and that just means that the producers are absorbing a margin hit. But as you see the dramatic increase in producer prices that's been going on now, that you would expect them to probably want to exert a little bit more pricing power. But having said that, durable good orders continue to track positive, and that last data point in the red shows a bit of an uptick, but I think the bottom line here is that if you're looking at sequentially month over month data, it's been positive here, tracking ever since the pandemic impacts began to wear off in the summer. And in our last chart of the week, I'd like to just highlight the International Monetary Fund data, which if they're looking at it objectively and they're looking at the global economic backdrop, that in 2020, as we kind of look at this, we know that essentially China is the only one of the major countries to post a positive gain in economic growth, and they're at 2.3%. And I've highlighted some of these areas in 2021, in particular the U.S. is expected to show more than double the growth that we had in 2019 as kind of this bounce back. And I'd say a lot of this, may happen in the first half of the year. And based on, if you get past some of the noise effects, maybe of the weather that will maybe impact a little bit of the first quarter for the regions that were most impacted. But if you get into second quarter, there is a chance that you could have some of the best economic growth posted in 2021 that we've seen in a long time. That will do it for this week. I hope you've enjoyed this presentation. Please feel free to reach out at the information provided. On behalf of the entire team at BKA, we wish you a safe week, a happy week, and we'll talk to you again soon.